try and say g'day. In Canada, we say good day. But by way of introduction, my name is Jan Robard. I'm the managing partner of Dawson Partners. We're an alternative asset manager based in Toronto, but with offices in New York and London. We were established about 10 years ago. We've got about $25 billion of assets under management, 230 people, and we operate basically in the secondary market. So what we are is we are a provider of liquidity. We inject liquidity into an otherwise illiquid asset class. And because of that, we operate in a market that has been growing quite substantially here over the last few years. We think we approach the market in a different way. We're providing customized, bespoke solutions to folks looking to generate liquidity in their private equity portfolio. But really what we're here to do is talk a little bit about the dynamics in the secondary market and what we've seen over the last little while. So first, thank you to our friends at CI. Thank you to GSFM for allowing us to participate in this conference, and we appreciate you all so much. We want to lay the framework around this. Last year was a record year for the secondary market. There's $160 billion that traded in the secondary market. And the reason behind that is because there's been a lot of pent-up liquidity needs in the secondary market, in the private equity market. Everybody's kind of heard about that. Over about 50% of private equity investors are over-allocated to the asset class. And over the last few years, it's been a difficult road in the private equity market. But really, to understand why private equity investors are so over-allocated, you need to go back to 2021 to really be able to understand the full story. 2021, private equity actually did really well. Post-pandemic, it generated outsized returns. And private equity investors found themselves victims of their own success because they had done too well and they were over-allocated to private equity. And then in 2022, public markets declined, and that compounded their over-allocation. In 2023, distributions dried up. In 2024, returns in private equity were anemic, and that has created huge havoc in the private equity portfolio allocations of many private equity investors. So the natural place to turn to is the secondary market. And that's what has generated a lot of volume in the secondary market, certainly over the last few years. But the problem with the secondary market is that it is vastly undercapitalized from our perspective. And the way to really put some numbers around that, since 2021, there has been $620 billion deployed in the secondary market, but only about $420 billion raised. That's a lot of capital that has been deployed and not enough capital that has been raised. And that makes it a buyer's market from our perspective. And that makes it an interesting market as a participant that is injecting liquidity in this otherwise illiquid asset class. So from our perspective, what we're operating in is a market that is growing significantly, that has a lot of pent-up liquidity needs, that we are providing liquidity in that market, and that has a huge amount of growth going forward. And when we say a huge amount of growth going forward, we want to put numbers around that. There's about $15 trillion in private capital out of assets under management. And remember, last year was a record year at $160 billion. That means that only 1% of private capital actually turned or churned in 1 year. Imagine a market where more than 1% churns in a year. That is the opportunity set in the secondary market. Well, first of all, thank you so much. What we would say at Dawson is without investors, there would be no Dawson. So we appreciate your time, your willingness to listen to what we're doing. And the moose here behind us, which we're based in Toronto, says goodbye for the folks down under. We appreciate you. We're like cousins up here in Canada, and we thank you, and we wish you all the best today.
Yeah, thank you, GSFM and CI, for putting this together, and thanks for having me. It's a real pleasure to talk to you guys. My name is Don Young. I'm a co-founder and co-CEO at Canal Road Group. We're a private credit manager in the U.S., based in Miami. You can see the backdrop. But we were in New York. Our last company, we had a company called C-Band Partners that we built up to about 15 billion of AUM, and we sold it to Carlyle back in 22. M&A is kind of what drives our lending business, because it's basically when, let's say, Apollo or Blackstone wants to buy a company and they're going to pay $1 billion for it, but they want to borrow 400 and write a check for 600. We'll be part of the group that lends them the 400 million to help them buy the company, and we generally charge about 10% interest for that. And like I said, that's historically really high interest rate for being first lien risk against a pretty big company with a lot of equity below you. Like I said, for most of my career, that was mid single digits or lower interest rates. Now it's double digits. So that's been that the volume of those deals is usually driven by private equity firms buying companies from either from each other or from spinouts from public companies. But it's been slow just because I think the volatility in the markets and the higher interest rates have dampened private equity appetite for buying. Two things. One, the liquid credit markets in the US are trading at multi-year tights right now. So, high yield bonds, investment grade bonds are the tightest, lowest yields they've been in years. So you're getting in at the absolute worst time, probably, if you want to get into the US liquid credit markets in recent memory. The private credit markets are at not the wides, but very, very far from the tights, double the tights. The other thing I would say is, you have to understand that liquid credit markets are great in that you can get liquidity, but when they are much more volatile. So the private credit markets are much less volatile, and that's why we think it has a place in everyone's portfolio. Number one, like I said earlier, it distributes cash every quarter, and it's very low volatility and not correlated to the rest of the markets. I think the regulatory environment has gotten a little bit better for the banks, but not much better. The government was going to clamp down on their risk capital ratios, and I think they pushed that out a little, so they feel a little bit less paranoid about using their balance sheet. So I would say the competitive environment is still pretty good, and there's a lot of good companies. I would say the one thing that's happened in the last year or so has been that the M&A volume has slowed down. And part of that was driven by, all of the tariff announcements and all of the volatility that came around back in April. And it's really, amazing when you think about it that, 4 months ago, the VIX was at multi-year highs. People were jumping out of windows and, thinking the economy was going to go in the toilet. And now we're right back to all-time highs on stocks. Crypto is through the roof. People are launching SPACs again. It's a fascinating reversal in a very short period of time. I'd say it's certainly below 50% loan to value, meaning the company is worth $2 billion. It should have less than $1 billion of debt on it. That way, if something does happen to the industry or that company, you have a lot of equity cushion. A lot of private equity has to get vaporized before you lose any money. You want to be in sectors that are that are not prone to major disruption. It's an interesting time because I would say a lot of areas that we all considered safe havens for a long time are not as safe anymore. So as deal volume picks up, I think you'll have maybe even higher yields. The other interesting thing about this is it's a floating rate. Our loans are floating rate, and I know Australia. You guys have already cut rates 2 or 3 times, if I'm not mistaken. We haven't really started yet, and there's an argument to be made that we will. Our president is like banging on our central bank to do it. But we still have inflation here, and the job market is softening, but costs are going up. It's not a great recipe for I wouldn't want to be the head of the central bank right now. Put it that way. Yeah, thank you so much to GSFM and CI for putting this together. It's great to see you guys, and I'd love to follow up and talk to you anytime you guys have questions about the U.S. credit markets. I'd be happy to follow up, and hope to come down and see you guys real soon.